Hi everyone, it's Jack back with another video, and today I'm going to be talking about what I think is one of my favourite UK value plays at the minute, and that is Boohoo stock. Absolute disaster of a year. It's down 70% nearly year to date, 85% in the last 365 days. It was once a £4 stock, or over £4, so total down from all-time highs, over 90%. Perhaps at the highest point valuation was a bit carried away, in fact more than perhaps, the valuation was certainly carried away at the top. But this certainly seems on the surface an overreaction. This business is now trading at about 6 times 2021 earnings for a business that until this year was growing steadily at 40% over the previous 3 years. It's performing really well. Of course, there has been some controversies, all the things with the slavery accusations in Leicester and working conditions. Of course, they've issued profit and revenue warnings. They've generally been bit quite hard by inflation, cost of living changes and things like that, and general demand failures. But this is a business that I believe over the next 5-10 years has real potential to prove into perhaps be a $5 billion company from a 500 million market cap right now. So there's really potential for this company to bounce back to its former height and surpass them. It will be hard to characterise the most recent quarter as anything other than a bit concerning. Revenue of £882 million, that's down 10% year over year, and while it's still up 50% since 2019, which is a decent measure of performance, excluding the pandemic years essentially, that's still not very impressive. They've had significant market share gains in this time, and their international revenues up 35%, with a massive increase in customers, up over 6 million over the last 3 years. There's still a lot of challenges for this business. Foreign exchange is impacting their sourcing tremendously due to the weak pound. Freight costs have been a big problem for this company in the last couple of years because they find it very hard to push price rises onto the customers because it's fast fashion essentially. They're trying to target cheaper markets essentially, and that has been weathered somewhat by the purchase of Karen Millen and Debenhams, more higher end brands, but this is still a massive problem. Plus inflationary cost pressures, soft demand due to the cost of living crisis in the key markets, particularly the UK of course. These are all massively affecting revenue, and to be honest, kind of 2 to 3 year issues, or at the very least short-term issues that I think this business can get past. And with the measures that they're implementing going forward, I think this business has real potential to, in the next 5 or 10 years, to get back to where it once was. Looking at the income statement for the business, as I mentioned, group sales down 10%, primarily due to softening demand in Q2 in the UK. Gross margin is resilient at 52.5%, down from 54.6% the half year prior. So that meant gross profit came in around £464 million, down from £533 million earlier. Adjusted EBITDA, £35.5 million, that's down around £50 million, so that's a pretty decent decline, 58% change. Is to be expected when they're seeing a massive gross profit hit. Cost inflation, elevated returns versus half one last year in pre-pandemic, and elevated freight and shipping costs have really bitten down here. They still have a relatively strong liquidity position with $315 million in gross cash, but they have been taking on a little bit of debt to support their expansion, which I'm going to talk about in a minute. Overall, this is obviously not a good trading update, a quarterly report, but it's the half report. This is obviously not a good income statement to see, but there is definitely things to be worked with here, and I don't think this is the end of the world by any means. Looking at the historical financial performance, until this year, which it must be said, many businesses struggling this year. Not every industry can be completely resilient, and this is very much an industry that faces tremendous inflationary cost pressures, freight costs, and of course there's a cost of living crisis in which people are just not that keen on spending on larger brands and spending on clothing when it isn't necessarily needed, when they're choosing between clothing and heating the homes or higher food costs. There is not much of a competition there. You look at the growth profile, they've grew revenue at really strong rates every year for since 2017, 51%, 97%, 48%, 44% and 41% over the last 3 years. This is a business that prior to the troubles of this year was growing at a really strong rate, with adjusted EBITDA margins in the 10% range and a strong and increasing net cash position. These are all things that I really like. Of course, at these times, the valuation was highly inflated because it was, and rightfully so in some ways, because it was growing at 40%. And when it stopped growing at 40%, then rightfully so, the stock price will take a big hit. But I still think 37p or something that it's trading now. Just seems like a ridiculous overreaction to what I think are relatively short-term problems. It's still going to record over £1.5 billion in sales for a $500 million or £500 million market cap company with, 50% gross margins. This is excellent in my opinion, and all the foundations they're laying, the cash they're spending for the future is looking good. When you look at how this business capitalised over the last 3 years, particularly on the pandemic, they grabbed market share at a much faster rate than their competitor, which is tremendously impressive because some of these are quite big names. You look, many companies growing in that over 30% range. ASOS, JD Sports, these are not small names by any means. Next, Inditex, which is basically Zara, Primark and H&M, which I would consider key competitors for Boohoo, didn't really grow at all because they were bricks and mortar businesses. Among the online businesses, Boohoo has best in class amongst its reasonably sized competitors, in my opinion. 73% growth rate over the last 3 years. That is very, very strong. They grew their online market share from 5.6% to 8.4%. And their online penetration from 28% to 42%. These are all excellent metrics, and if they continue this, I think this could be a nice little business and far higher valuation than its £500 million market cap today. In addition, some of the big capex projects they are taking on, things like this automation project in Sheffield, they're in the first phase, it's now live, significant capacity expansion, they expect a payout within 5 years. This is going to be accretive to the gross margin. You would expect the gross margin to rise as they increasingly automate the things, and this is exactly what you'd be looking like a company like this to do to push its market advantage even further. The majority of Boohoo's business, and therefore its infrastructure, was started in the UK and is still the UK. The UK is by far its biggest market, but is nowhere near the highest total addressable market. And if they want to be a big name, if they want to be a multi-billion pound business, then they need to be approaching large markets around the world. And things like the improving the US distribution centre, this is an absolute key thing, because getting next day delivery to key markets, they'll be able to cover 95% of the US within 3 days versus the 10 days currently. This is absolutely essential. If I'm ordering something and I have two websites where they're roughly similar, and one is 10 days and one is 3 days, you best believe that I'm buying the 3-day one, regardless of a couple of pounds difference in price. That is just, we live in a convenience economy now, and if they can get that time down from 3 days to 10 days, then that'll be a boost in sales immediately, because I think that 10-day delivery time will put a lot of people off for relatively basic items like a white t-shirt, for example. They're on track for phase 1 to go live in mid-2023, and we're watching very closely to see how things like this impact the US sales. Of course, I'm going to expect to see a larger marketing spend going into the US, but I think this is par for the course and exactly what I want them to be spending the money on, because this is absolutely not a slow growth business. This is not a business where I'm looking to see them pay a dividend, grow 5 or 10% a year. This is a business that I'm wanting to see grow 20% for the next 5 to 10 years, and I think that's absolutely possible with the measures they're putting in place. I think it's obvious that I like the Boohoo business model, and one of the key things I like about this business model is the purchasing of other brands, for example like Karen Millen and Debenhams, bringing these in-house, because brand equity is massive, customer loyalty to certain brands is huge, and it allows you to just have a higher gross margin and higher return customer percentage, which Boohoo traditionally does very well at compared to its competitors. I think this is absolutely key to the success of this business going forward. I think their movement into other markets like America and their approach to doing this with improving infrastructure early and then going hard with the marketing and things like that is absolutely what they need to be doing, and a very sensible approach. I like the management team here, and although I'm not particularly happy with the profit and revenue right now, I recognise that this is, to me, a relatively short-term issue, and I kind of think there's a built-in margin of safety here, because I don't think Boohoo as a business is going anywhere. They have a more than healthy cash position to keep the business ticking over. I don't think this is a business that's going to go bankrupt or disappear, because I think people will very much notice if this disappeared, because it has a loyal customer base. And at 37-38p, I think there's a built-in margin of safety here to where I'd be happy continuing to purchase some shares. I am already a Boohoo shareholder. The cost ratio is around 45-50p right now, and I'm more than happy to keep increasing that position at this price, because I think this could potentially be a 5 to 10x company in the next 5 to 10 years, because I think it will. There's a strong, in my opinion, there's a strong likelihood this is a business that can bounce back in a post-pandemic and post-high inflation world. I don't know how long that's going to change, but I think once these external pressures come down, this is a business that could really thrive. I think they have a good chance of getting a foothold in the American market, which could be huge for this company. But of course, let me know what you think. Let me know if you're buying or selling this stock. Let me know if you think it's an absolute pig, or if you think it's a rough diamond. Whatever you think, let me know. Like and subscribe if you enjoyed the video. I'll see you again next time.